Good. It is 11 o'clock. We should get going because there's a lot to cover this morning. So I've got some news. Then McHattie is going to be talking to us about what happened over the course of July. And then I'm going to be talking to Richard Pindar, who's the manager of Lonsdale Capital. News-wise first, three things that I pulled out. So Gore Street Energy Storage, Hydrogen One Capital Growth, and Oakley Capital Investments. And of those, we can do Gore Street first. So, familiar sort of picture with these things, where the share price started off a cliff and the NAV sort of edged down a bit. But you see the NAV did turn in October last year, and this is sort of edging up again now. The discount is still way too wide, 38%. And part of the reason why that discount is wide is because that yield has come down quite a lot. So if we were talking about this a year ago, it would probably be in double digits, but they've cut the dividend now, and so the yield that I put up there, 4.7%, is the minimum that you're going to get, which is 4 lots of 0.75p. So brief history of this. So we've had one dividend cut already. That was in July last year. And at that time, the whole battery sector was very much out of favour. And then things changed a bit in March when Drax bid for Harmony, and then subsequently, obviously, there was a bidding war, and Foresight eventually ended up winning that and taking it out at asset value. In June, they announced they were going to cut the management fee and launch a strategic review. And we were awaiting the outcome of that and the final results when RM sent in a requisition to change the directors. But when these results were announced on the same day, they cut the dividend again, which is the one we've just been talking about. There is a top-up, though, available. So basically, if they free cash flow more than covers that 3p dividend, then they'll pay out the balance. And there are scenarios in which you could get back to about 7p again. So this week we had the result of the strategic review announced and the circular for the EGM published. So the key to what they're going to do for the strategic review is to turn what is an interesting asset, which is the pre-construction assets, into an income producing one. So they've got 8% of the portfolio at the moment that doesn't generate any income. And they're going to look at what they can do with that. So they might sell some of it. They might bring in third parties to help them as co-investors to help them build these things out. They're going to also upgrade the existing assets that they've got to make the battery storage, the discharge time longer. So financing that, they've got some cash. Obviously, they've got some cash left over from the Big Rock tax credit. They've got the existing loan facilities that they haven't really much used at the moment. And obviously, there may be some money coming in from those sales that we talked about earlier. So that's a tick, tick, tick. There are other things they could do. So Grid's done a couple of things where it has done a tolling deal with Octopus, and then it's also been putting these revenue floors in with the idea that if you've got predictable level of income, then banks are willing to lend you more money. So just hiking up the gearing. I don't think that would be particularly attractive, to be honest, but nevertheless, they are thinking about it. And they're also looking at what they can do to cut the overheads. So this is the pre-construction portfolio. So a few things in there in Ireland, Texas and the UK. My initial instinct was, well, the Texas thing can't be worth an awful lot of money given what's happened with Trump. But actually one of the weird things in the One Big Beautiful Bill, OBBBB, is that it kept the tax credits for energy storage projects. So even they seem to, I think they forgot about it, but I think we don't know. But I think it's they recognise that they've got to balance the grid, and so energy storage is an important way of doing that. So that's still worth some money and still could be sold or developed. The UK one, the Middleton, is a very big project, potentially 460 megawatt hours. It doesn't have an existing grid connection, so it's not ready to go straight away, but it is quite high up in the queue, and that in itself is a valuable thing because grid connections are difficult to get hold of. So that could be an interesting one to see what happens. And that's probably the one they bring on a third party to help them build it out. In terms of the upgrades, the question really here is why? Why now? Because you remember Harmony, when it first launched, was banging on and on about the value of having 2-hour systems, and saying that it was therefore a much superior fund to the others. Obviously, we never got to really find that out. But Gore Street says, well, actually, that what's changed is the price of batteries and stuff has come down. So it's going to cost them roughly a third of what it would have cost 2 years ago to put in 2-hour batteries. That's material change, and it's obviously the Chinese are chucking these things out. So it's going to cost between 18 to 22 million to upgrade 2 of their projects, Stony and Ferrymuir, and that can be done relatively quickly. So they're saying that they would only be offline for about 50 days, and they think they can get it all done next year. So my understanding is, and I don't know if it's definitely true, but my understanding is they've already started on this. So that will happen, but then they'll do the others following on from that. So they'll upgrade the whole of that GB portfolio there. And I wanted to just sort of focus on something because I've read a few things that are criticising Gore Street. One of them is that diversification. Why did they do it? I think it just shows you with these numbers here that actually it's been quite a lucrative thing to do. They're actually earning more money in Germany and Ireland than they were in the UK. And Texas, if we look the year before that, was much higher again, but it kind of fell off a cliff a bit because they had good weather. It wasn't as warm in the summer as it normally is, and so air conditioning wasn't switched on so much, so there wasn't the strain on the grid there, and that meant the fluctuations in power prices weren't as great. But nevertheless, that could come back this year. So there's a possibility that that's going to come back, and actually all of these things will be doing very well. And then the other thing is to point out that actually their revenues, I know we're not comparing completely like with like, because the Gore Street's ones are to the end of March and these are to the end of December. But on an annualised basis, they're earning more money than Grid did and more money than Harmony did for batteries per megawatt per year. So they're really not doing a bad job. They just don't seem to get credit for it. So they are looking at this idea of putting floors and stuff in. As I said, I'm not a massive fan of ramping up the leverage. But this is the one place in the statement they've said that if they could free up some capital from that might be used to return it to shareholders. Otherwise, all the money is earmarked to do these upgrades. Just to ram home what I was saying about the fact that they're actually doing a decent job, these are the direct comparing the NAV returns for Gore Street and Gresham, and you can see they're a lot higher. And again, I don't really understand why it's not getting credit for that. So the EGM will be on the 20th of August. If you're going to vote, you need to get votes in by 1 p.m. on the 18th, but obviously actually practically if you're going to vote you might need to do that a long time before that, probably at least a week before. It's a straightforward choice between keeping the existing board or backing the new nominees from RM. RM haven't really said what they want to do beyond sort of bust it up and maybe try and sell it. I just don't like the uncertainty that creates. I don't like the fact that they haven't got any relevant experience in the sector. I don't like the fact that they've been putting a sort of for sale flag over the business, which always gives you a worse deal. So my inclination is to vote with the existing board. Obviously, if we go through another year of poor returns, then no doubt there'll be people coming back again saying something needs to change. But I think they deserve the time to work out on the outcome of the strategic review and see how it works out. Hydrogen One Capital Growth, very similar chart, but much wider discount. 68% is extremely wide, but that is narrower than it has been. What the news that we had this week is that the board is recommending a managed wind down, and that needs shareholder approval, so there'll be another meeting to do that. But they've kind of jumped the gun a bit by sacking the manager and sticking RWC in, and sort of let them get going on it. So yeah, I think I don't very much doubt there's enough of shareholders in Hydrogen One that want to keep the thing going to block it, but nevertheless it does seem a bit premature. Now, one of the things that I'm not totally happy with is the way that Red Wheel's going to get paid. So they're basically going to get paid on the basis of what they can turn into cash. And if you get a premium to NAV, you get a bonus of 5% of the excess. If you get NAV, you get 1% of the realization value. If you come in lower than NAV, you get 0.75 of the NAV. That's all good because it means that Redwell actually aren't collecting any money until they sell something, which helps the fund's cash position, because that running out of cash is part of the problem. The problem, though, is that the reference NAV is going to be set by Redwheel in conjunction with an independent valuer. So the board's going to have to sign that off, but still, nevertheless, it does sort of put a big question mark how this is going to work. And if the NAV dives a lot and then they succeed in selling a lot of stuff for a premium, I'll be extremely annoyed. But I'm not a shareholder in this one, so there we go. Finally, Oakley from me. I love the fact that finally we can put up a chart that doesn't dive off a cliff in 2022 too. That seems to be the regular pattern with the things we talk about here. But no, Oakley's done a very good job. The NAV's been climbing. The NAV's still climbing. It's almost £1 billion now. The discount is still too wide, 25.6%, but it is narrowing. And I think it could narrow a lot further. So what we got this week was a new NAV. So at the end of June, that was up 40p or 6%. A lot of that came from selling VLEX, but there are also upgrades in those other 4 companies, and that's driven by earnings growth within those companies, not by any kind of change to the valuation multiples. So this is like, real growth going on here. Slightly offset by the fact that timeout's down again. That cannot persist really. It's down to like 16p a share. I would guess that there's a chance that Oakley or somebody else is going to take it private again. I don't really see how it can persist in the way it is. So it'd be interesting to see what happens with that. It was one that they wanted to get rid of, but obviously now's not the time. They're happy making new investments. They've had a very good track record of making new investments recently. There's been a lot. Interesting new things. We'll obviously write about them fairly soon. They got a little bit of money coming in from Dexter's, where they refinanced that company, and also the proceeds of VLEX to come in as well, so that we're not worried about the finances at all. They've also got enough money to buy back stock, so they've bought back 21 million quid's worth, and that's out of a 50 million program of buybacks, and they've already upped that once, so there's a possibility they'd do that again if necessary. But I think the key here is that they're moving to the main market. So it's been stuck on the specialist funds market. I know that a lot of other people can't buy it. It totally depends on your platform. I'd love to have done this all the way through. I've sort of slightly annoyed that I missed out on all of this share price move so far. But nevertheless, there is upside. And what I thought I'd do, because I keep making the suggestion, is compare it to HG. So these are the NAV total returns for Oakley and HG Capital going back 5 years, and as you can see there, they kind of move more or less in tandem, but Oakley has outstripped HG, and HG is the one that everybody loves. They're similar-ish type of portfolios in that they're sort of focused on growth type assets. A slightly different sector mix, slightly different sorts of companies, but nevertheless, Oakley's held its own and actually outstripped HG. But if you look at the discounts, HG constantly trades much, much closer to asset value. And I think part of the problem, maybe all of the problem, is that retail investors haven't really been able to buy it. So with this change, the move to the main market, we could see a closing low discount. That's what I'm hoping will happen. I'm hoping that I manage to buy some stock before it does, but we'll have to wait and see. Good. All right. I'm going to hand over to Andrew now. Let's go. Give you control. There you go.
Splendid. Lovely. Thank you very much, James. Obviously, when you start buying Oakley Capital, that will move the price up on its own. So we'll look forward to that. Good. I will talk about what's been happening in July in the markets, and actually, it was a really good positive month. I think actually, here we go. We've had a very strong rally in the investment trust sector. I think it's quite useful to have a bit of context. So this chart, it's a 1-year chart that plots the investment trust index in the black there against the FTSE All Share in the blue. And you can see actually that in the tariff tantrum earlier in the year, investment trusts really did fall off much more sharply. And that's perhaps because of the international exposure that was more greatly affected there by the potential tariffs. But we have started to see actually a bit of outperformance now from investment trusts, and that is reflected in the narrowing discounts in the sector, which have come in now to 13.7%. They were out at around 15 to 16. So we are seeing some value come back for investment trust investors. And actually in July, the sector index was up about 3.3%. So it was a good month. And you can see that reflected in the biggest rises in the sector. There's a special one at the top, Apax Global Alpha, which received a recommended bid. Effectively, that was friendly fire that's being taken private. And that has helped some of the valuations in the private equity sector. So it'll be interesting to see what Richard says about that, because actually that is a sector where there have been some quite wide discounts on offer. I think the other key thing I take from this list, and there's some quite good rises over the month, is that it's quite growth oriented. So quite a lot of these higher risk trusts have been performing better now. And I think that's a reflection of this risk on period in markets. And I'm slightly nervous because it's been going on for some time. So we'll see what happens. We'll soon be approaching the danger zone of September and October. But for the moment, those growth sectors are doing a bit better. And I've noticed in particular that we've seen the healthcare sector pick up, and also China. And China was, of course, hammered during that tariff tantrum, and it's really picked up quite a lot. And I've been talking to some emerging markets trust managers, and they've really been saying that they're finding some good value in China. Often we're comparing China with India, aren't we? And I think India is still expensive, although there are very good companies there. Anyway, I'll talk about the biotech bounce a little later. And let's have a look at the fallers. I think it's interesting to note that Life Science REIT is at the top here. Now, Life Science REIT is again proposing some kind of corporate action. We don't know what it's going to be yet. It may end up being a managed wind down, but effectively they've hoisted the for sale flag, and we'll see if there are any bidders for the portfolio. But what they've done there is that they have announced a new net asset value, which was considerably down. I think it was down 11%. And that again, I think, is a matter of clearing the decks and preparing for the sale. And I was really interested in what you were saying about Hydrogen One capital growth, James. I think that's probably going to have a pretty severe haircut in its NAV when that's announced. Obviously, it's in the new manager's interest for that to happen. But overall here, the falls were not too sharp over the month. The one I will talk about is Augmentum Fintech. I've been a bit surprised, given the rally elsewhere in the growth sector. I've been a bit surprised to see the weakness in that one, so I'll just have a talk about that. So let's start with the biotech. And I'm really coming back to this sector because I did talk about it in my segment on the June show, where I talked about how badly it was lagging the US market. And we have seen something of a bounce since. Now, this chart is a year-to-date chart, so 7 months, and it shows the NASDAQ Biotech Index in blue against the broader NASDAQ Composite in yellow. And you can see actually that to some degree, the biotech sector didn't fall too badly earlier in the year, but equally it hasn't had that much of a bounce since. So if you look at the short term, it has been underperforming against the broader NASDAQ market, which of course has been very much driven by IT again. And biotech's been out of favour. There have been a lot of worries about the US Health Secretary and the new policies that are being implemented in the US. So there is quite a lot to worry about. But I feel that the sector is being dragged up now, along with all other sectors in the US. So we have seen actually a bit of a recovery come through. And that's interesting, I think, in the context specifically of the trusts available to us. This is the healthcare sector, and I've ranked them here by 6 months NAV return, and they're all negative. And it's quite interesting to think about that in the context of the graph I've just shown you, which wasn't that bad. A lot of this has to do with a currency headwind. So the dollar weakness has really been hurting these companies because inevitably most of their portfolios are based in the US because that's where the biotech industry is. So it's been quite bad overall, but there is quite a lot going on in the sector now. And I think this quite extended period of underperformance we've seen has triggered some corporate actions. So we've seen Syncona move to start a managed wind down, which might take some time, and we don't really know what value is going to be released there, but there's, I think, some hope of some value uplift. We've seen Saba take a stake in Worldwide Healthcare, which was quite surprising to me. It's a big chunky trust, but again, I think it indicates the value on offer. And I think the really interesting one is the one at the bottom of the list, which is Bellevue Healthcare Trust, which has had a really awful time of it. Now, it does have a very concentrated, idiosyncratic portfolio, which is actually also based on companies down the capitalization spectrum. So I think it's been particularly at risk actually during this difficult period. So it stands out actually as being a poor performer. But I think what's particularly interesting is that the board instigated a new discount policy in April. This was really in reaction to the failure of its prior policy, which was to have an annual redemption opportunity in November each year, which was actually quite enthusiastically taken up, but didn't really control the discount. And so the board thought it would try something different. So it's been trying a zero discount policy. Now, you can say this has worked, because if you look at the chart here, which is a year-to-date chart, you can see actually that the discount narrowed very successfully when this policy began in late April, and it has been maintained up until a week or two ago anyway, but that's really come at a cost. So in fact, in order to maintain this zero discount, the board has had to buy back an enormous number of shares. I think far more than it would have originally anticipated. So it's actually bought back over 83 million shares, so about £100 million worth. And that means it shrunk the size of the trust from 280 million down to 174. So this is not a sustainable policy, because this trust is going to disappear if this continues. And actually, you can tell that the buybacks have been of a greater magnitude than was anticipated, because pretty much every month the board has been having a new meeting to renew the authority to buy back more shares. It's having another one on the 12th of August. So we'll see what happens here. I can't see this continuing as it is, because the trust is going to shrink too much. And I'm not sure it's been beneficial for shareholders either, because of course the trust is not buying back its shares at a meaningful discount. In fact, the average discount it's bought back at is 1.2%. So it's not as though existing shareholders are getting real NAV accretion from this. So I don't see it continuing, but it's going to be an interesting one to watch, I think. Let's move on to another topic. And I think this is particularly timely because last night in New York, there was a very big IPO of a Californian software company called Figma, which is a big IPO, $19 billion. Well, it was $19 billion at the IPO price. Actually, there was massive enthusiasm about the shares. They went up 250% and finished the day with a market cap of over $60 billion. And I mean, that's clearly a lot of froth in that, but I think it does indicate actually the potential enthusiasm that can greet these new issues in the US. And that's maybe a bit different from the UK. Again, I'll be interested to hear what Richard says about how private markets are likely to pick up in the UK. But there's been a lot of press reports about potential action in the US, really. And that's covered companies like SpaceX, Tide, ICAEW, which is one of Seraphim Space Holdings, and Starling Bank. And it's all about the US. There's very little about IPOs in the UK at the present time. In fact, there's been quite a lot of coverage about companies preferring New York to London because they get a higher valuation. But nevertheless, this is, I think, good news generally for the investment trust sector. This is my last slide here. And I'm talking about so the SpaceX potential revaluation is very good news for a number of Baillie Gifford investment trusts that have large holdings in SpaceX. The Starling Bank news has helped Chrysalis Investments, although I think actually the IPO for Starling is probably quite a long way off yet. ICI has helped Seraphim Space. That's been a tremendous story. If you don't know what's happened with Seraphim Space, go and have a look at the share price chart. It's amazing because actually without any change in NAV, you've seen the shares drop from over 100 pence down to 27 and now back up to about 86. It's been a phenomenal roller coaster ride. And then I think the really interesting one here is that there have been press reports of the US private equity firm TPG taking a stake in Tide, which is a UK digital banking platform. And that's the largest holding in the portfolio of Augmentum FinTech. It's a 24% holding in the portfolio, so very significant. And in spite of this potentially good news, because I think that would probably come in at a higher valuation, Augmentum FinTech is on a 43% discount to its last NAV. Its Z-score, which reflects its current rating in relation to its 12-month average, is negative, so showing that that discount is wider. And I don't think the trust has really joined in with the rest of the growth capital rally. You saw that the shares were down 10% over the month, so that might be worth a look. I think that's where I'll leave you with that idea.
Great, thank you very much, Andrew. No questions I can see for you, so we shall move on and bring in Richard, if we can. There we go. Hang on a second. Now, for some reason, Richard, it's not saying I can give you control of the slides. I don't understand why. So you're going to have to ask me to move them. That's all right.
Okay, I can just give you instruction. That'd be really helpful. Thank you.
Fair enough. Good. As per usual, we're going to get you to tell us a bit about the trust before we go to some questions. So I'm going to hand over to you, please, first, and then tell us about Literacy Capital.
Great. Yeah. Well, no, thank you. Good to see you. Thank you for the time to speak today. So if you just flick over to, I'm more than happy just to intro myself. So just most recently set up Literacy in 2017, set it up with Paul, my father. We were initially a private vehicle and were run as a private vehicle for nearly 4 years. So we set up in September 17 and we listed on the London Stock Exchange in June 2021. The initial funding into the company was at £1 a share. We floated at £1.60 a share, and we've not unusually, we've not issued any more shares since. So we've quite deliberately just run the company and grown it organically without issuing any more primary issuances either at the listing or since. Just go on to the next page. So in terms of what we seek to do, and I guess kind of key points of difference, the overview on literacy would be we solely invest in UK-based businesses. We want to find opportunities in businesses where we can take something that's very small, that's been owned by founders and family members, and I guess be typically the first external investor to help them take something that has been well loved and looked after for years or even decades, and help to take them onto a sort of journey of accelerated growth. So that, I guess, is what we've been after doing or been trying to do in the last sort of 7-8 years. That can often work with two different types of founders. So often it's either founders that have been with the business for maybe decades, and a sale of the business is part of a retirement plan or succession planning. And so that type of situation would more often lend itself to there being more significant management change as part of the transaction and part of the deal that we're seeking to do. And then the second part might be younger founders. So quite often we'll have founders that set their business up 5 or 10 years before. They've started it from sort of the bottom and probably won the first customers and sort of grown it from there. But they realize that it's taken them quite some time to grow it to 5, 10, 15 million of turnover. In order to get it to 50, 100 million of turnover, they would probably like to do it more quickly than they could under their own steam. And so often then they might reduce their 100% shareholding to a significant minority shareholding, or even remain majority shareholders, but want to work alongside a partner, and that might be us. So those are sorts of the deals that we're seeking to do. As it mentions on the slides here, the investment trust status, or the investment trust structure that we have, lends itself very well to those types of businesses. More patient capital, more pragmatic, more flexible. And we also have an unusual situation where there's significant alignment of interests amongst, I guess, myself as CEO of the manager, but also a significant shareholder in the fund. And that situation is also true of Paul and also the other directors. And I'll touch on that later again regarding, I guess, some of the concerns around the broader private equity industry and what it might mean for investors and managers and conflicts, etc. And then we do also have this unique charitable objective, which I say unique. I don't think there's anyone else that does it that I'm aware of, whereby we donate a proportion of our net assets every year, and the clue's in the name of the fund, but we are primarily focused on addressing sort of chronically sort of poor literacy amongst large numbers of children across the UK. Obviously, if children at 5, 6, 7 are struggling with reading, that limits their potential in other areas of education, but then also longer term in their lives as well. And so it's a pretty effective, cheap way of trying to give particularly more disadvantaged children more opportunity. And so since we set up, we had this objective from the very start back in 2017. We've given away nearly £12 million, which is quite a significant proportion of the 54 million that we actually originally raised. So again, reason for mentioning it is some investors really like that, some are less bothered, but actually it does have a genuine impact on many of the founders and many of the companies who are quite proud of being able to say that that's what their shareholder also supports, and their growth and their efforts can also help to increase those donations that we give to charity. So it's an important part of the overall investment package. Thank you, James. So I briefly touched on, I guess, the types of situations that we look for and many of the founder dynamics that we often see as part of the transactions that we do. In terms of kind of taking that kind of a level further, We are sector agnostic. Anyone that looks at our website will see a variety of different sectors, from software to healthcare to consumer businesses to travel businesses, recruitment, a real array of different businesses. What we do like are businesses with reasonably healthy margins. We do like businesses that generate strong cash flow. Businesses that have low margins or poor cash flow or require significant amount of capital to grow, we would tend to be less enthusiastic about. We do also, as I mentioned before, often have to be able to provide management or talent into the businesses, kind of, full-time hires. And so again, the talent that we might have on our benches also needs to marry up to the situation. So often that is a constraining factor on our interest in different businesses. As a result of all of this, we're very conservative in terms of leverage that we'll use on day one. As the slide mentions, it's sort of 1x, 1.5 times EBITDA, which is often more akin to what a public company might have. So it's very different to a normal private equity buyout, which would be using much more leverage as part of their structure to generate the returns that they want to make. That can and does change as time goes on, and once we've got a business that is more mature, is larger, has a more stable, more established management team, as we have done and as we've been doing in recent times, we might end up refinancing those businesses just to allow us to recycle some capital. But even today, the net leverage across the sort of top 10 holdings is not drastically higher than that. It's probably about 2.5 times. Very flexible in terms of the deals we'll do. We listen to what the vendors want, and we'll take that into account, and we'll usually be able to find something that works for us and works for them. So both minority and majorities are on the table for us. Again, it's hugely important to us to be able to have the trust and have the vendors want to choose to work with us. This is not like buying a Vodafone stock or a Rolls-Royce stock where you go on a platform and you buy and sell the stock. You're dealing with people, with individuals. You're dealing with their circumstances, their businesses that they've worked with often most of their lives. They want to have trust in the person that they're dealing with to be honourable in the way that they deal with them, but also trust that they can do the right thing for the business and look after it. And so, again, by dealing with those people in a straightforward way, by having cash immediately available, all of those things are not often features that people see when dealing with particularly sort of smaller end sort of M&A transactions with sort of different pools of finance that might be available. I've kind of touched on some of this stuff again, but again, the family dynamic that I've touched on the vendor side, again, it's quite helpful on our side of the table to have something akin to that. We've done deals recently with husbands and wives. We've done deals with second generation, so sons and daughters working in businesses that their parents own. That's pretty common. And so for all of those reasons, the structure we have, the team that we have, the access to management talent that we have is very well suited to the businesses that we then want to invest in. And again, I'll bring some examples to life sort of in a couple of slides' time. James, if we could just go on to the next one. So I guess if we take a slight step back, I mean, we've touched on it with James and Andrew before around, I guess, some of the recent news and the features of private equity and some of the attractions of it. I mean, if you go back any reasonable period of time, the last maybe 10, 15, 20 years, Andrew would know the facts better than me, but the sector in terms of the investment trust space that tends to do the best, or certainly close to the best, would be the private equity sector. And I guess, why might that be the case? So there are an increasingly large number of businesses, for a variety of reasons, that are choosing to remain private. And as James just touched on, the IPO market now for some time, and certainly still is in the UK, very much shut. So if you do want access to high quality, high potential businesses, then you need to be investing in them privately, because not many of them in recent years have been listing. So that is a key attraction generally, I would say, to private equity. The other benefit is private equity investors, they're not passive stock pickers. They don't invest in businesses, sit there and then allow them to pasture for several years and then sell their interests and collect the cash and send it back to their LPs. They are taking quite significant stakes, and they are actively engaging and involved in the strategic decisions of those companies. So again, then the question for investors is to say, well, do I back the judgment of those people? What's their track record like? Can they actually add value? Is their input value additive? I've seen lots of instances where that's not the case. So, I mean, yes, it's a good thing that they have the ability to use that influence and that control, but it needs to be done in the right way. The returns that, as I've mentioned, have been very good. So the gross returns, particularly compared to public markets and other types of assets. I've put the caveat there around fees and carried interest and the cost associated of that, to the actual underlying investor. And particularly some of the conflicts. So there's some question marks there relating to private equity in general. And again, the investment trust universe has been around for a very, very long time, sort of, well north of a century, used for decades now with private equity. But that structure lends itself extremely well to, the private asset class, the actual underlying companies themselves. So again, listed private equity should be an attractive asset class for many investors. If I then say sort of specific to Literacy Capital as to why we believe we've got an edge, and our track record since we listed and since we set up has been good. We quite deliberately focus on smaller businesses. Again, if we go back to the financial incentive for private equity, their senior people will charge 2% of the funds under management, and they'll also take carried interest, so a share of the profits that are generated on disposal of the assets that they've had in that fund. But as funds get bigger, that 2% or close to 2% figure that they might charge becomes an increasingly significant part of the financial incentive. And also we've seen many private asset managers themselves list in recent years, and that recurring nature of that fee income is much more highly valued by listed investors than the more lumpy, unpredictable carried interest that might also be received. So as a result of that, they want funds to be larger because the recurring income that they generate off those funds is larger. And so as a result of that, if you've got a larger fund, you need to focus on larger assets, and that's what they've all done. Typically they'll want 8 to 14 assets in a fund. So if you divide whatever the fund size is by those sorts of numbers, then you're going to sort of end up at where their average check size is. As a result of that, by focusing on much smaller businesses, our website would say 1.5 to 5 million EBITDA. There is just a dearth of providers of capital or buyers of those businesses, and as a result we end up paying far lower entry prices, and as a result it gives us a really good opportunity to generate multiple arbitrage at the point we exit our investments if we can get them right. So we would end up paying a fraction in terms of entry multiple than what we would expect to pay, that we'd expect to sell those businesses for. I guess the other key benefit also is the access to talent that we've got. So, Paul ran a business for nearly 30 years. We've got other non-exec directors that have also been founders of businesses. I'd say as much of what we do is around recruitment and hiring and people than it is actually sourcing investments. And so we've also seen firsthand where we've had the right founders that we've backed, or we've brought in the right talent to assist those businesses or those founders. The impact on those businesses has been transformational, and we can generate significantly outsized returns for our shareholders compared to what, bigger private equity managers, where often they're buying from other private equity managers. They've been through this process already. There's not so much low-hanging fruit, and so that opportunity for us is significantly greater. And then the final point there, I mentioned around some of the significant drag on investors' returns by performance fees or carried interest. there is no performance fee or carried interest that the Literacy's fund manager charges. And the primary reason for that is such a significant share of the fund is ultimately owned by the founders, by the directors, by the the team in the investment manager. A large part of it would be paid for by ourselves, and it just wouldn't make sense. And so the sole driver for us and the sole funds that we manage is Literacy Capital. We've never issued another share. We don't plan to. We don't plan to launch another fund, a successor fund, a fund 2, a fund 3, a fund 4. There's no reinvestment that takes place where we keep part of an asset. That takes place off the same balance sheet. There's no Literacy Capital 1 selling to Literacy Capital 4. There's none of those conflicts of interest, and so it's a very clean structure that we have. I understand why the private equity do it, and it can work, but it does create some uncertainty. It raises obvious questions. So if we could just go on to the next slide there, James. Maybe the next one. So this is the composition of the portfolio as it is today. I probably wasn't going to dwell too long on this. It's a slide people, hopefully, if they've heard me before or looked at any literature of ours before, will have seen. This has obviously been updated for the most recent position as at the end of June. Yeah, as you can see, it's a relatively concentrated portfolio, and for the reasons I've kind of alluded to previously, a lot of those larger holdings are where we've effectively run our winners. We've made very strong returns on those investments. Our total cost on RCI was less than £3.3 million. We've had all of that money back. We've had over 20 million back from RCI, and the residual stake's still worth close to 100. Velocity, as we've announced, I mean, the returns now are quite well publicised. It was close to 15 times our money on that investment. Grace, again, we invested about 2.1 million into that business, and we've had back several £1 million from it. So again, sort of the total return on that is close to 20 times our money. And I guess the other thing that is worth saying is, as time has gone on, we've increasingly focused. I mean, it's that fourth bullet there. We've increasingly narrowed down the types of situations and the types of investments that we want to make. So at the outset, we did do some earlier stage, some growth capital investments. So the likes of the Augmentum or the Seraphim that sort of got mentioned before. Strictly and solely now, we are focused on profitable, cash generative, owner managed businesses at the point we invest, and helping them onto a journey of taking them to 100 million enterprise value or above. And so, you know, we've worked out what works well, where the risks are, and that's what we're seeking to do. And those businesses there, which I can come back to shortly if anyone's got any particular questions, they all fit that remit. So we just can move on to the next slide, James, just conscious of time. So as I mentioned, I mean, performance of the funds since we listed has been very good. We originally issued the shares at £1 a share. The shares today are probably about £4.36, I think, at last time of checking. The net asset value is just over £5 a share. So in terms of after all costs, after all donations, net assets have increased more than fivefold in the past 7 years. It's also worth bearing in mind that we obviously started out as just a cash shell, so it did take some time to invest that cash. So there was a period of cash drag, which you can see in sort of those 2018, 2019 figures there, until the fund became more fully invested. It's also worth making the point that there is often quite a belated J curve on some of these investments. There is quite a lot of work and effort and investment that is required to turn quite small businesses that had been managed in a certain way for many years into something that is more exciting, is more attractive, is of the scale, and is positioned in a way that makes it attractive to larger buyers. So that does take some time. And I guess the only other thing that's probably worth mentioning there is just in terms of the 2024 performance. I guess that was primarily held back for, I mean, the macroeconomic conditions in the UK at that time were the weakest they've been for a very long time. And also we had a couple of businesses that were quite significant detractors in 2024, which had been extremely strong contributors to 2021 and 2022. So, I mean, if you were to strip out the effect of those two businesses in 2024, that the NAV growth would still be mid-teens positive. But equally, if we were to take their contribution out in 2021, the NAV performance would have been up about in the 50%. So we're still overall very happy to have made those investments. It's just their contribution was quite steep and quite early, and then it had sort of lessened as time had gone on. But overall, the NAV assets, the NAV assets per share the net asset per share has increased quite significantly since inception, and we're quite hopeful that will continue, given the types of investments we're seeking to make now are still very similar to the ones we were seeking to do 1, 2, 3, 4, 5, 6 years ago. And just the final point there, I've alluded. Sorry, just go back. That's it. Just the final point there. The transaction that was announced on Monday of this week was the sale of Velocity, where a very significant return was made. We also actually partially reinvested alongside the incoming investor there. So both of us now have a significant minority shareholding alongside management. And I would suspect, they would have a usual private equity time horizon and a typical private equity return expectation. And so I suspect we would end up then selling the residual interest in that business in another sort of 3, 4, 5 years' time, when hopefully the business has scaled further from where it is today. Which is probably good timing to move on to the next slide there, James, if I just give a bit more colour on that, because it's obviously some new news that's recently come to market. As I mentioned and have alluded to, these types of businesses take quite a period of time to develop. So here is a bit of a timeline with some sort of, I guess, key headlines as to what has happened in the last 5.5 years since our original investment. Originally, the business was called EPM, Bus Solutions, so it was solely focused on the bus sector. It was a small software business. It was set up by an individual whose initials were EPM, hence the name. He had owned the business for decades, and as a result of being in his 70s, he wanted to find somebody to take the business on and to kind of give it a fresh lease of life. We bought a majority stake in the business. We owned approximately 2/3 of it. As a result, considerable influence, and could input significantly into the decisions that the business would take. Since buying the original EPM business in February 2020, the business bought 3 other businesses to just develop and broaden its capabilities, increase the size of the markets that it sells to. So what those acquisitions also did was take the business quite significantly into rail. So the business has exposure now to both the bus and the rail sectors. There was also a kind of key focus on internationalizing the business. So as mentioned there was a significant contract won in Hong Kong. There was also a significant contract won this year in Saudi Arabia. And we've also done what we've done in many other of our portfolio companies. We've brought in new members of management for kind of what is needed and the challenges and the opportunities that our businesses face. So in 2024, a new CEO and a new CFO were both hired with an eye on a transaction in due course. And I guess that kind of helps to paint a picture of the patience that is needed, the time and the effort, and then also the result that has been generated for shareholders. There are not many exits by private equity that generate that type of return. In order to do that, you do have to do something a bit different to others. Hence why we do focus on the smaller end of the market, where the dynamics are more favourable, where more value can be added. And I think this page kind of goes some way to helping bring some of those messages that I've kind of rapided on about for the last couple of years, helps bring that to life. And as the final bullet there mentions, I mean, we weren't desperate to sell this business. It's doing extremely well. but we did get a significant amount of interest in the business from private equity, and CBPE are funds that we've known for some time, and the individuals there for a long time. We were very happy to be partners alongside them, and hence, the reason for doing that deal where, as I mentioned, we are still quite a significant shareholder in that business, and if the business continues to do well, then we will share in a significant proportion of that value creation. Just move on to the next slide. That, I think, broadly is all I kind of wanted to say, and I just wanted to leave time for any questions that people might have, and you as well, James. But sort of, yeah, by and large, the focus for ourselves, we're not planning to change. There has not been any deviation in anything. There's probably been a slight narrowing in the types of things that we do want to be doing or don't want to be doing. The returns have been very good. Despite UK macroeconomic conditions not being brilliant, it's still very possible to sell businesses. We still plan to. We still expect to make more investments. And actually, when the market is weaker, we tend to find increasingly favourably positive investments to be able to make. Just again, reduces competition even further. The portfolio generally is performing pretty well, despite obvious challenges that businesses might be facing at the moment. And then again, many of the criticisms, if I can use that word, that private equity suffers from, we've tried to negate those as much as possible, with the significant skin in the game and the alignment between manager and the fund. And then just a final reminder there around the charitable mission as well, which has served us very well thus far. But I'll stop talking there in case there are any specific areas that people wanted to delve into while I'm on the talk.
Great, thank you very much, Richard. Couple of questions that we should probably tackle head on. I mean, it was trading at a premium, loved by investors, and then you did hike the management fee and cut the donation to charity, and that didn't seem to go down so well when the discount opened up. What was the thinking behind that? What was the reasoning for that? And what can you do about the discount now, do you think?
Yeah, so I think the share price reduced slightly, I would say probably 2 or 3 months before the change to management fee or donations. And actually what we saw was, I think it was around June time, bearing in mind the change to the management fee was announced on the 8th of October last year. What we saw around the summertime was some significant private individuals that had been sat on some significant gains because they'd bought into the funds whilst it was private, were selling and realising CGT before potential changes to CGT, which were expected to be announced at the end of October, which then were announced. I guess if you look at the share price performance in the 2 weeks after the change in management fee was announced, there was no change in share price. And actually the only change was in the days leading up to the 30th of October. So I've personally not heard any negative feedback regarding the change. And I think the reasons were that, again, kind of alluding to some of the comments I made before, the amount of input and time needed and the size of the team that we need to have to deliver the types of returns that we want to make and our shareholders would want us to make, it wasn't possible with the level of management fee that we had. And also, if I'm honest, the size and the step up in the fund meant that we wanted to make sure that all the charitable donations were being spent extremely well. And so, I mean, the overall increase in cost to the shareholders was 20 basis points, which is pretty modest. And it was just a redistribution from sort of charitable donations to the investment manager. And there have been a couple of new hires at the investment manager level to kind of, demonstrate where that money has gone. And there are other things that we're doing as well differently now as a result of that incremental income. So, I mean, it's quite a labour-intensive exercise and asset class. I mean, it's part of the justification why private equity managers would ordinarily insist on 2%. The fact that we're still at 2% inclusive of the charitable donation is primarily because we're happy to forego income and salary to have better net returns on the shareholdings that we have. So yeah, I don't want to sort of protest or decry it too much, but I don't think when we spoke to institutions, they understood, and it was generally received neutrally or positively, that we were trying to take action to provide more support to the portfolio companies. And then your ultimate point about discount, I mean, I guess if you just flick maybe to page 9, if you're able to, I would say the fund was on a premium, very significant premium, and and justifiably large premium, I would say, of 50% plus in, say, 2021, 2022. But also, if you look at the NAV growth in that period, it was exceptional. There aren't many investment trusts that have ever recorded NAV growth of that kind of level. And as you can also see from that row in the middle of the page, the NAV growth in 2024 was much less spectacular, albeit for our worst ever year, it's still not terrible. And so I think there just needs to be more news flow. There needs to be more exits. There needs to be better NAV performance. I think we've got slightly better NAV performance thus far this year. We've just announced the exit on Velocity. We're trying to do, I think, all of the right things to generate more interest and more awareness of what we do. We're still small as a fund. As we build to 500 or 1 billion of net assets, then we will inevitably come on more people's radar. We will attract more interest. We have also announced, as part of the sale of Velocity, that we would return capital to investors. So again, we don't have any wish to just hold on to capital and charge fees on it. We want to, do the right thing for shareholders. So yeah, I think there's a variety of levers that we can pull, but equally, our overwhelming priority and focus has been and will be NAV growth. And ultimately, if NAV growth is good and it improves, then I would hope in time that discount will disappear and we can continue to trade on a premium again. But yeah, in the interim, we just need some patience, really. These are a liquid asset. They are big. So we're doing our best in the interim to get the best performance that we can.
Great, thank you. In terms of, am I right that you are also on the specialist fund market, like Oakley I was talking about earlier? Yeah.
Yeah.
So is there a plan for you to move to the main market?
There's not a plan at the moment, but I wouldn't rule it out. There are some different and more onerous reporting requirements, and there are some specific. I mean, the benefit of the specialist fund sector is the rules have been written for funds and the clues in the name. And if you do move on to the main market, you do end up having some foibles foisted on you, which are not really appropriate for funds. So I wouldn't rule it out. It's not something that we're actively planning to do. But if, again, Oakley is a good example. Their performance, again, is good. I'm a personal shareholder in Oakley. It will be interesting to see if there is any change once they do move to the main market. TBC.
Cool. Okay, thank you. In terms of sort of the picture of the UK, because obviously you already said 2024 wasn't a great period. Do you need decent economic growth and everything firing on all cylinders to make money, or will these companies just grow regardless?
I think we're confident that they would grow regardless. I wouldn't say all companies are immune to the weaker conditions that we saw in 2024. And also, I mean, the one that lots of businesses have complained about, and thankfully we've not seen it hugely significantly, but is around obviously employers' national insurance contributions and the increase in those. And many businesses have seen very significant cost uplifts as a result of that. But generally speaking, I mean, the bigger impact I would say is on M&A. And again, if you look at private equity trusts in the last year or two, M&A has been fairly muted. 2024 was the lowest period. I think it was the third consecutive year where M&A levels had fallen. Q1, I think, was the lowest period on record since COVID times. And again, part of that was all of the newly announced things relating to tariffs, which were obviously having a global impact on different businesses. And until there was some visibility on how things might settle, new investors were not going to be prepared to spend tens, hundred billions of pounds on a new investment whilst all of that was going along. So I'm not so concerned about there being tremendous economic growth. I mean, it would be nice if there was a bit more stability and, there was more certainty, and it relating particularly to, taxation and things like that. But what would be almost more helpful, and I think there are signs of it, and I mean, the Velocity transaction is a good example. There are signs that investors are happy to invest, and they've got capital that they do need to invest. And so they are feeling pressure to do that. And again, I think lots of the news that you touched on earlier in the show, there are a lot more mature murmurs of things happening than there were 3-6 months ago, when everybody was just flatly saying no to things. So that would be tremendously helpful, I think, just to the private equity industry in general. It would be tremendously helpful to NAV returns. If you look at the premium typically realized by private equity on exit, which again undermines many of the concerns people have around the lack of visibility or the opaque nature of valuations within private equity, valuations or exits on valuations tend to deliver positive news rather than negative. And so I think if we could get a bit more churn in that respect, it would be positive for sentiment more broadly.
I mean, you've got sort of a couple of quite big businesses there. Should we read into the fact that they're big and you've held for a long time, that they're more likely to head for the exit, or are you happy to hold things for a very long term?
It's a good question. I mean, I would say, broadly speaking, businesses we've owned for longer, it's more likely that we would be thinking about selling them. That being said, we can and we would own businesses for a long time. RCI, we're not expecting to sell imminently. Velocity, we weren't desperate to sell, but we listened to what management wanted to do. They quite understandably wanted to realise some value for themselves. Members of management at RCI have done that, but we've just done it through kind of internal mechanisms rather than bringing in new equity partners. So there's a variety of ways that we can deliver or meet the needs of everybody that's a shareholder in our portfolio companies. But quite obviously, as time goes on, we've owned businesses for longer. The wishes of other people that are shareholders in those businesses is likely to be, I've been a shareholder in a private business now for 5, 6, 7 years, and I've not received any value for it. We do listen to those concerns or wishes of people. And equally, if we've owned a business for a year or two, it's much less likely, particularly given the condition that we inherit many of our businesses in, or the amount of work and investment that's needed. It's quite unlikely we would do a quick flip that many private equity investors might be able to do. So yeah, broadly speaking, yes, but there's sort of a bit more. There's a bit more thought or a few more considerations to it.
Great, thank you. I know we've run on a bit. We should probably wrap it up there. But thank you very much for talking us through HotSeat Capital this morning, Richard. And we'll get you back on again another time. There's the disclaimer. And I'll be back next week talking to Rhys Davis from Invesco Bond Income Plus. So do have a good weekend, and we shall see you next Friday.